Hello everyone, this is Vicky here. In this video, I'm going to break down some of the trickiest but most examinable ICAEW BPT topics, including remittance versus arising basis, SEIS relief, hybrid mismatches, and your ethical duties as an SAO. Let's make it simple, sharp, and exam ready. So let's go. In this example, we are going to talk about Raj, who is non-UK domiciled individual but resident in the UK. So we will talk about his income tax, capital gains tax, using remittance and arising basis. I'll break down the calculations and considerations, including the impact of seed enterprise investment scheme relief, as he has invested in one, and potential penalties for inaccurate tax reporting, because in this example, we are pretending that he is also an SAO. So let's understand the basics. Raj is a non-UK domiciled individual. He has got two choices: arising basis, remittance basis. What does that mean? Arising basis is when you are taxed on worldwide income and gains regardless of whether they arise. And remittance basis is you're taxed only on UK income and gains and foreign income gains only when remitted, brought into the UK. So let's say you've got an income coming in from a property or some business in Dubai. If you opt in for the remittance basis, you don't have to show that income into your income tax computation. So you are allowed to exclude it. But you will be taxed on that income if that income comes into the UK. So the UK authority is going to tax on that income as well. Now, in this case, as you can see, with the remittance basis, there are some strings attached. So number one, if you are non-UK domiciled individual, resident in the UK, you've got two choices: arising basis, remittance basis. With the arising basis, you're taxed on worldwide income. But with the remittance basis, you will be taxed on UK income plus any remitted foreign income. You will be charged RBC, which is £30,000 if you have lived in the UK in between 7 to 9 years, and 60k if you have lived in the UK in between 12 to 14 years. So you pay the RBC, you don't get personal allowance, you don't get AEA. AEA is £3,000, and your personal allowance, as you know, is 12,570. You're not going to get these if you are a remittance basis user. We'll see top 3 tax implications for Raj. So let's see. Now, Raj has paid £60,000 as remittance basis charge. He doesn't get personal allowance AEA, and he will be taxed when he is going to bring the money into the UK. He doesn't have to bring the money into the UK, but if he wants to, he can. But if he does, he will be taxed. Now we'll see income tax and capital gains tax calculations on a rising basis. So let's say Raj's income tax and CGT liabilities, if he is opting in for a rising basis, let's say his income is 260, and we call it as taxable income because he is not going to get his personal allowance because he is earning more than 125,140. Automatically, you don't get personal allowance. It doesn't matter if you are using a rising basis or remittance basis. His taxable income is coming from non-savings income, 260. His dividend income, let's say he's getting 12,000 from the UK, 45,000 from overseas. No personal allowance because his income is high. Taxable income is 260, rates, as we know, 20%, 40%, and 45%. And then he will have a number before SEIS. Now, in this example, of course, we are showing that Raj has invested in an unquoted trading company, a newly formed unquoted trading company. So he might get SEIS. And if he gets SEIS, in this example, we're using that he is going to get 100K as a tax reduction. So his income tax liability is going to be 25,239. Now, remember again, no personal allowance. Why? Because his income exceeds 125,140. So he's not entitled to a personal allowance. SEIS relief, Raj invested 220, let's say, in a qualifying SEIS company. He only gets 50%, but that is up to 200K, which means that even if he has invested 220,000, his reduction in taxable income is only going to be 100K, which is capped at 200,000. So which means that even if he has invested 300,000, 400,000, whatever, it will always be calculated on 200K. So as we can see in here, his income tax liability is 25,239. If you look at his capital gains tax calculation, let's say he has a painting in which he has made a gain of 175450. Any gain from remittance of funds unknown. Let's suppose if he has remitted the money into the UK, but if it has not been invested within 45 days, that might be taxed in the UK. So we will look into that. He is going to get 100K again in his capital gains tax computation, which means 100K he got in his income tax, 100K he will get again in his capital gains. He'll get 3,000 AEA because he is using a rising basis. His taxable gains is 72,450, 20% tax because he is higher or additional rate taxpayer. His liability is 14,490. Now, with the key points, SEIS CGT exemption. SEIS investment allows Raj to exempt 100K of capital gains tax. And Raj can deduct annual exempt amount 3,000. Once again, he is using a rising basis. Now, Raj's remittance tax exemption. What happens if Raj remits 220,000 from Gogoland to the UK? Normally, it would be taxed. Is there any exemption? Yes, if he invests in an unquoted trading company within 45 days. Now, he is bringing 220,000 from abroad. He has to invest this in a company which will qualify him for SEIS within 45 days. If he doesn't, he has to pay the tax on the 220,000. Now, one thing which you need to note is that the taxable amount isn't necessarily 220,000. It's a gain from the original disposal that generated those funds. So in this case, we might need more information to calculate the actual taxable gain. Income tax and capital gains tax, remittance basis. Now with the remittance basis, what's going to happen? He's only taxed on income and gains brought into the UK, not worldwide income. Foreign income not remitted to the UK isn't taxed. Any downsides? Yes, because of course he has to pay RBC, no personal allowance, no AEA. So what should Raj do? He needs to carefully consider the implications of this choice on his overall tax situation. So after doing the calculations using remittance basis, we've got the income tax liability of 7728. Of course, this is after we deduct SEIS relief, but no personal allowance. Remember, SEIS will be given it to you, whatever, if you're using a rising basis or remittance basis, it doesn't matter. His capital gains tax is 15,090. Again, after SEIS relief, but no AEA. So his total tax payable will be 82,818. Income tax, capital gains, and 60K your RBC. Now, over here, he's paying 82,819, which is more than what he was supposed to pay if he were to choose a rising basis. Now, Raj's role as SAO and hybrid mismatch. Let's say Raj is a senior accounting officer. He's responsible for what? Certifying the adequacy of the company's tax accounting systems. Now, in this case, let's make one example that you have got a company, your subsidiary in BVI, British Virgin Islands. British Virgin Islands company is giving loan to XYZ Limited. So this company, which is in British Virgin Islands, is giving loan to the XYZ Limited. XYZ Limited has to pay the interest. Now, if that interest is not being taxed in BVI as an income, it will create a hybrid mismatch. So as you can see in here, that interest expense deduction is only allowed when that income is being taxed on the other side. But because the other company is in BVI, in that jurisdiction, it is untaxed income because BVI tax exemption applies. In the UK, you might say, well, I'm paying the interest because I got the loan at an arm's length. I can have a deduction. No, you cannot. You can only have the deduction if this income was being taxed elsewhere. If it's not being taxed, it is hybrid mismatch. Now, you might have the directors who would be saying, well, it doesn't matter. Well, it does, because interest deduction is disallowed in the UK in that situation. So if Raj listens to them, let's say, he is going to face penalty of £5,000 for inaccurate tax reporting. So what are the Raj's ethical obligations? He has to discuss with the directors. Raj needs to discuss the hybrid mismatch issue with his fellow directors and explain the consequences. He has to correct the return, the corporation tax return. The corporation tax return must be corrected to disallow the interest deduction. If that is not happening, he might resign, because if the directors refuse to comply with the UK tax law, Raj may need to consider resigning as an FD and SAO. You should consult with the ICAEW Ethics Helpline. Now, again, if you look at this, how should Raj address the hybrid mismatch issue? He should resign if the directors are not listening to him. The corporation tax has to be corrected without allowing that interest payment. Discuss with the directors and any consequences they might face. So what is our ethical obligation? As advisors, we must ensure the corporation tax return complies with the UK tax law. If the client refuses, we must inform them of our concerns in writing and consider resigning from the engagement. I hope you liked this video. If you have any comments, any questions, please let me know, and I will see you in the next video. Thank you.